On Tuesday, November 8th, the United States will hold midterm elections to determine which political party will hold a majority in the House and Senate. Ongoing uncertainty around inflation, monetary policy, and the economy may impact market volatility around the elections this year. Using CVOL indexes, we looked at volatility in the 10-year Treasury options immediately before and after the last few major elections. The yellow line in the graph illustrates how much higher implied volatility is currently compared to the last 3 elections. Volatility declined in the day following the presidential election in 2020 and midterm election in 2018. However, after the 2016 election, implied volatility continued higher. Perhaps even more interesting was the shift that occurred in 2016 in the option skew toward the calls on Treasury yields.
In both the 2018 midterms and the 2020 general election, implied volatility declined afterwards, as we may have expected. But the biggest difference is where rates are starting going into the election. In 2016, the 10-year was grappling with 2%, 2018 3%, and now we're sitting at 4%, but with an inflation climate that we haven't seen in 40 years. This pushes volatility to what seems like an extreme. In general, the market, whether it be the equity market or Treasury market, does not like uncertainty, and that leads to higher volatility. Implied volatility is likely to subside post-election, but the real determinant will be how quickly this rising rate environment we're in may eventually start eating away at the persistent inflation that we are experiencing.